Hi, and thanks for watching the 12% Solution. I'm Stephen Carter, and today I'm going to give you a brief overview of what the 12% Solution is all about. Now, what you really need to do is to go to Amazon and get the book yourself. Now, yes, this is a sales pitch, but the fact of the matter is, reading this book is going to give you all the information that you need to implement this strategy yourself, month after month, with a couple trades to bring back an annual average of 12%. So go to Amazon, get the book, learn the material, but now I'm just going to give you a sneak peek of the 3 primary steps involved in bringing about a 12% annual return. Check it out. Step 1 of the 12% Solution is fairly straightforward. Take your overall investment, whether it's your retirement account, whether it's money you have set aside just for stocks and tradings, and I want you to take that and look at just 60% of that amount. So if you have $1,000 to trade, you're going to take $600. And that 60% you're going to be putting into an ETF. Okay, now what is an ETF? An ETF is an exchange traded fund. Think of it as a bundle of stocks. So you're not just buying one stock like Apple or Amazon. You're essentially buying an entire volume of stocks with that investment. What you're looking for is an ETF that tracks the S&P 500. So the S&P 500 is a collection of the 500 largest traded companies in the United States. It includes things like the Apples, the Amazons, the Teslas. And in doing so, you are buying one small piece of all of these companies. You are essentially, by nature of this, diversifying your investment, yet only buying one fund. You see, an ETF trades just like an individual stock, but yet it's a collection of stocks. So on that level, it is by its nature a much safer trade than an individual stock. So 60% of your money is going to go into an ETF, probably one that tracks the S&P 500. Now, the very specific details are based on a strategy that, again, you will learn when you read the book. But that's step 1, 60% into an ETF that tracks the S&P 500. Now we're going to talk about step number 2. Step number 2 is where you create a sort of insurance policy for your money. So if you put 60% into that primary ETF, with the remaining 40%, you're going to be looking for something that typically has an inverse relationship to the S&P 500. Something that when the stock market goes down or crashes, this usually goes either up or at least doesn't drop as far. Now, it's not a perfect science. So we're looking at this in back testing up to 10 years. And what you find is a very interesting negative correlation between certain categories of investments and the S&P 500 or major stocks. You might see this in things like gold and precious metals. You might see this in utilities. And you especially see this when it comes to bonds or treasuries. So for this second step of the 12% Solution, we're going to do what's called a hedge. We're going to create a hedge. I'd like you to think of this as a sort of moat around the castle, a moat around your financial fortress. You're creating a buffer so that in a perfect world, and again, know that there is no perfect world out there, especially in the financial world, you are essentially creating a way wherein if the stock market were to crash, you have a buffer, you have an insurance policy that typically, not all the time, but that typically has an inverse relationship to the stock market. So it looks something like this. If the S&P 500 begins to track down, these major bonds or treasuries will often track up or at least not go down in the same relationship. You're basically hedging your bets. So by taking 40% of your money and putting it into a major ETF that tracks bonds or treasuries, something like TLT, for example, what you're doing is, again, further diversifying your investment, but also creating that hedge to protect you against major fluctuations in the market. So again, step 1, 60% into an ETF, exchange-traded fund, that tracks the S&P 500. 40% into an ETF that is bonds or treasuries. This leads us to step number 3 of the 12% Solution. I'm not going to go in depth on step 3, but I'm going to give you enough details to show you that if properly executed, this is the final piece to bring about those bigger returns. It is called the cash trigger. Imagine this. Again, it's a perfect world scenario, but imagine knowing exactly when to pull your money out of the stock market, just as the market begins to dip, so that when you put your money back in, you can ride the stock market all the way back up to where it previously was and then to new heights. That's the principle behind the cash trigger. Now again, it's not perfect, but when implemented regularly and when implemented based on the strategies laid out in the 12% solution, it does yield higher returns. By implementing these 3 steps, 60% into the major ETF that tracks the S&P 500, 40% into an ETF that tracks bonds and treasuries, and implementing a cash trigger, the 3rd step, you are going to see returns on average of 12% or higher. Now again, to get the fine details and the specific tools you need to do this yourself, check the book out on Amazon, The 12% Solution. Hey, make sure you subscribe to this channel because we're going to give a lot of tips and strategies related to this and investments in general. So subscribe, and thanks for watching.